A regional trading bloc is a group of countries within a particular region that come together to promote trade and economic cooperation by reducing or eliminating trade barriers such as tariffs and quotas. Examples of such trading blocs include the Common Market for Eastern and Southern Africa, COMESA, the East African Community, EAC, the Economic Community of West African States, ECOWAS, and the Southern African Development Community, SADC. While these trading blocs are formed with the aim of improving trade and development among member states, several challenges hinder their effective functioning. 1. Insecurity and civil wars. Civil wars and internal conflicts in some member states create insecurity and disrupt trade. For instance, countries like South Sudan and the Democratic Republic of Congo have experienced prolonged unrest, making cross-border trade risky and unreliable. 2. Political differences. Differences in political ideologies and leadership styles among member states often lead to lack of cooperation. Disagreements between governments may delay or block important trade and economic decisions. 3. Unequal levels of industrialization. Some countries in the blocs are more industrialized than others, leading to overdependence. For example, countries like Kenya, Nigeria, South Africa, and Egypt are more developed and tend to dominate trade, creating imbalances and sometimes resentment from less industrialized partners. 4. Production of similar goods. Many African countries produce similar primary goods such as tea, coffee, and maize. This reduces the incentive to trade among themselves since there is little diversity in what is available for exchange. 5. Threat to local industries. Free trade can harm local industries as cheaper, tax-free imports flood the markets. This has affected sectors such as the sugar industry in Kenya, which struggles to compete with cheaper imports from other member states. 6. Loss of government revenue. Since member states remove taxes on goods from within the bloc, governments lose out on the revenue they would have collected through import duties. This affects the country's ability to fund public services. 7. Poor transport and communication infrastructure. Inadequate roads, railways, and communication systems make it difficult for goods and services to flow smoothly between member states. This slows down trade and increases the cost of doing business. 8. Failure to pay membership fees. Some countries fail to remit their annual contributions to the bloc, leading to financial difficulties that affect operations, programs, and the running of the secretariats. 9. Low purchasing power. Due to widespread poverty in many regions, the local population may not afford to buy goods, even when they are available. This reduces the volume of trade within the trading blocs. 10. Negative perception of locally made goods. Many people in African countries prefer imported goods from outside the continent, believing they are of higher quality. This perception reduces demand for products made within the regional blocs.